Hi. Hi. Good morning, everyone. Good afternoon or good evening, depending on your time zone. Um, Welcome to those of you who are on YouTube. I don't see anyone yet on the Zoom, so we will wait 5 minutes till about 8:05 New York. It's now 8 o'clock New York in the morning, and we'll start at 8:05. I have a fair amount of material to go through, I think about 30 slides, so um, I do need to start relatively promptly at 8:05. If you're on the YouTube, please go into the chat and say hi. And I've posted the chat here on the Zoom as well. I'm going to mute until 8:05. Hi, good morning, everyone. This is to the YouTube audience. which also might be people watching this as a playback at a future date. It's 8:05 in New York, and we're going to start the talk now. Let's see, I have to get the order of steps right here. I'm going to share my PowerPoint. And from the beginning. Okay. All right. So today we're going to be speaking about counterparty credit risk, CCR, within the context of model risk management. That means the validation and the management of counterparty credit risk models. I'm Jonathan Schachter. I'm doing this Zoom from Brooklyn, New York. And my company is Delta Vega Incorporated, which is my personal consultancy. So first of all, what is Mrmd, which I pronounce Mrmd? So this is a weekly Zoom and a YouTube live stream on model risk management in MRM in general. I started it to get feedback on a textbook that we're in the process of writing. We have it as a manuscript, and our first submission to the publisher, Academic Press, is coming up. It's December 1st. However, publishers work slowly, so the book will actually not be in print until the summer of 2026. Yes, it seems a long way off. But the purpose of Mrmd, then, is to preview some of this book content and invite comment on MRM topics of interest. And apologies, I'm on a Brooklyn street that sometimes is noisy in the morning here during the morning commute. So if someone plays their car radio or car stereo loud, like they were 10 seconds ago, you may hear some of that in the background. But we can manage that like we can manage models. All right, so the talk has 5 sections and a 6th and 7th that tell you how to get onto this meeting in the future if you need, how to look at the archive, and how to contact me directly. So the first thing to talk about is CVA, because I would say that's the 0th rung of the ladder, the bottom, that one needs to have some sort of understanding of that. And that will presuppose, some understanding of concepts like loss given default or recovery and so on. I can expound on those one-on-one or in text dialogue in LinkedIn if you're not familiar with those things. But CVA is mainly something that's on the desk. I associate it with pricing. So that's the risk neutral probability measure. In general, in risk management, we deal with the historical measure. Think of VAR, for instance. The equivalent in counterparty credit risk is one of these exposure quantities that I'll define, but PFE is the one that I'll end up spending most of the time on. It's basically CVA, but in the historical measure, if you will. Now, there are some times that CVA and some assumptions break down. So the most common, and so what that means is that the CVA or the PFE that you calculate is underestimating your counterparty's risk. So in this case, an underestimate is dangerous because the loss that you most likely will incur will be, could be many times the CVA or many times the PFE, I mean. All right, so PFA is generally calculated. Here we are in the second over here on item 4 using a Monte Carlo. So I'll give the basics of how you do a Monte Carlo, and especially focusing on seeds. So this is a hand holding some seeds. I don't know if people garden out there. I garden. I just planted my fall seeds, hoping that some of them will come up before our first freeze here. So then a discussion of variance reduction and things such as Sobel sequences. Finally, regulatory reporting of CCR, PFE specifically will be touched on, but that's basically just a Basel formula, which I will not make an attempt to explain. But that in a sense, PFE is used for capital. So it's something important to understand how it's done. So let's first talk about credit valuation adjustment, which is, again, a pricing measure of counterparty credit risk. I think somebody just logged in. So if you can mute yourself, that would be great. Just text me questions and we can cover them later. There'll be time for questions. Okay, so you can think of CVA historically. I put up a headline from the Great Financial Crisis. I actually worked on the Lehman account after the bankruptcy. So I've seen some of the deals that made them collapse. But essentially, empirically, traders started changing customers an extra fee because of counterparty default risk, counterparty credit risk, CCR. So essentially, if you have a customer with no counterparty credit risk, there would be no upcharge. But realistically, there definitely were upcharges. I want you to focus on this integral here, because this is the formal definition of CVA. So it's an integral over the time that you expect the position to mature or to be on your books as a banker. And here are the risks that you're exposed to in the counterparty. So there is an expectation taken under the risk neutral measure, the Q measure. And within that expectation is the product of two terms. One of them is the loss given default, which is the complement of recovery. That is, it's one minus the recovery. This is a term accounting for both currency differences and also for expected exposure, exposure at default. So that's essentially the position size that, is there at default, and that's essentially how much you might lose as a function of time. This is then integrated over the probability of default. And all these quantities, as I said, are associated with the counterparty. Remember, again, it's risk neutral, and the expectation is taken of the product loss given default times exposure at default. So this is just repeating what I just said. Okay. Now, under certain circumstances, the CVA expression can be simplified. For example, there's a product in expectation, but it could be that one of those could be taken out of the integral. Of course, the expectation itself is an integral, but so it takes two leaps of faith. But essentially, if the loss given default and exposure at default are independent, then you can take the loss given default out of the integral. What that means is that the recovery of the loss given default is regardless of the exposure to the counterparty. They sell some short positions. They start off at $100. They go up to $1 million. And, your counterparty, I guess, is it is in such good financial shape that even if the position that they owe you $1 million in the future is sitting there, they still have very good credit and they can pay it. That doesn't usually happen. So let's go to the more realistic cases. In fact, let's go to a pathological case. Supposing a counterparty sells puts, let's say it's a public company with stock and it has puts trading. So it actually sells these puts on itself and it provides its own stock as margin. So if there's a bull market, there's no problem with that, in that you can buy back these short puts at lower values because the stock has gone up and the puts are going more and more out of the money. Meanwhile, the stock is appreciating, so therefore the pledged collateral is appreciating in value, and there won't be any margin calls. However, there's always a downside. So on the downside, there are big problems. If the stock tanks, then the short puts are going to be deeply in the money. They'll go from in the money to deeply in the money. They get more and more expensive. Meantime, the collateral that they pledged is going down in value. So there'll be lots of margin calls. And at some point, the counterparty may be unable to buy back to close those put positions. So that could lead to, you tell me, default, bankruptcy, and that's a good example of wrong way risk, which we'll spend some time on in part 3. But first, let's talk a little bit more about PFE, potential future exposure. So it's a VAR type question. You're asking, what is the loss from this particular deal or this portfolio of deals with a counterparty that I might expect over a year, let's say the next year. Because after all, these deals are often bilateral, and if they're unwound before maturity, second bullet here, the bank may make a loss. It also might make a profit. These are payments, let's say, going both ways in a bilateral deal. PFE has some cousins. I won't spend that much time on it because it's the most common exposure that's used. Okay, so Canabaro, sort of a giant of counterparty risk management. Sorry for the typo. This is not punt, but counterparty. So the idea is basically that it's like a 95% quantity. At 95% confidence, what's the loss? We'll discuss the differences with VAR, but this is purely simulated. And so, you can simulate the whole portfolio and read off this 95% PFE. Indeed, in the CVA case where we're risk neutral, so for example, this is how a log normal process evolves. So that's the pricing measure, right? And like any asset on the desk, it's something that you discount the expected value under the risk neutral measure. But PFE isn't done that way. It has to do with essentially the simulated history. So that's a pretty big difference. In fact, if you're new to this, that is a fundamental difference between, or a general difference between the front office, which exists in the pricing world. That's the first line of defense, and the middle office or risk management, which is the second line of defense. That the second line uses the historical measure. So it uses historical probabilities for all risk management. The consequences of that are just to go on a tangent for a minute. Think of the Titanic. So the Titanic essentially was doing a kind of actuarial analysis and trying to infer the risk of hitting an iceberg from past shipping. Not really trying to capture what the expected risk would be in this particular voyage from Southampton, England to New York City. So basically, no disaster had ever happened like the Titanic. So they provisioned for lifeboats on the basis of, the worst disasters that they'd seen in the past. Insurance companies work the same way. They basically are only going on past knowledge. Indeed, many things do that. I'm a big baseball fan. You may be football fans around the world. And many of the statistics are just derived from, the player's past performance, which, just like in predicting asset values, past probabilities may not be a guarantee of future probabilities, right? That's the difference in the measures. All right, so the roulette wheel here is to remind me that we're going to start to talk about simulations, such as in Monte Carlos. Now, in the case of VAR, which may be a little bit easier to understand, you have several options. You can do, we cover these in the book in a separate chapter on the statistical measures of market risk. So the simplest that is taught is usually just using a variance covariance matrix. And then if that covariance, that is to say, if the variances and the covariances, in particular the correlation coefficients, are stable, then that's a fairly good way to analyze an asset portfolio or just a many item portfolio. It could also be done with Monte Carlo, but most commonly it's done just using historical simulations, which is essentially saying that it is looking backward, but it's saying, this is why you're in the historical measure. So you look at all the day-to-day changes for a year, and you take today's portfolio through that, and you get a distribution of profits and losses, and then take a percentile of that. The nice thing about that is that you have clean P&L provided by your desk. And so therefore, you can look at what the 95%, let's say, worst loss was on a given day from the historical simulation and compare that to the actual P&L. And, you hope that only 5% of the time will VAR break. In other words, the loss will exceed the actual P&L. The expected loss will exceed the actual only about 5% of the time. Now, you can't do that with PFE. There's no such thing as clean P&L. There's no, this is all about future behavior. You can't, PFE is unobservable. It's only can be simulated. Therefore, it can't be back-tested in this manner. I can tell you that some regulators have asked about doing something like back-testing. The only thing one could do with PFE is compare it to another simulation. In the application of PFE, it's talked about as being something that the initial margin, this is not a talk about margin, but that it should define, in some sense, the initial margin that the counterparty has to put up, which is an upfront charge in some sense, like a CVA. Like the initial margin being 1 plus a haircut times the PFE for 1 year at 99% confidence. But and so then I guess you could look at how that initial margin, did it actually cover what was needed? And so that might be sort of an indirect way. I wouldn't call that back testing, but at least it could be kind of maybe more like an ongoing performance monitoring of whether PFE works. So I want to then now talk about wrong way risk. I'll talk more about the casino and the roulette wheel when I return to Monte Carlo's in section 4, but here's section 3. Sorry, section 3, I guess, is a slide or two away, getting ahead of myself. Let's look a little bit more about these metrics. I don't know if you've looked at coherent measures and subadditivity, but I'm going to cover that on sort of a light level here. In the real world, of course, VAR consists of multiple positions. So we would like to have some information on, which positions are most likely to contribute to the big losses, right? But because these are defined at a percentile, I can just tell you right away that the percentile of a 2-asset portfolio, that loss is definitely not equal in general to the same percentile of the first instrument, call it A, plus the percentile of the second instrument, call it B. Percentiles are not additive. But let's look at that. Let's look at positions A and B. We could, after all, compute the PFE of position A, the PFE of position B, and then of the combined portfolio. A coherent measure is such that the summed portfolio is always less than or equal to the individual PFEs. And so that's kind of a diversification benefit. By combining the 2 assets in one portfolio, we're reducing our exposure. But VAR doesn't do that, as just explained. That's just percentile. I'm happy to go off and talk offline about expected shortfall. Expected shortfall is based on a linear measure, an integral over the tail, and integrals are linear. So therefore, the integration of the tail for position A, all the losses above 99%, say, or the average loss above 99% is usually what's done. So the average of those losses plus the average of the B losses clearly you're just summing areas, is equal to the average loss for the combined portfolio. But PFE has no equivalent like expected shortfall does for VAR, so that's not that important. Risk metrics, which canonically, here's the reference at the bottom, canonically define how we think about VAR in many ways. It came out of a JP Morgan group, and JP Morgan is where VAR was essentially invented. So to try to get some idea of risk decomposition, this is what we're talking about on this slide. I have the whole portfolio, but what are the contributions of individual positions in that portfolio? So they define two concepts, which I'll expound on in the next slide. That's incremental VAR and marginal VAR. So let's again represent this as a very simple portfolio that we have some weights, WI, and some positions, SI, so that the value of the portfolio at any time is just the sum product. Then let's define, as did risk metrics, the incremental VAR, or the IVAR, as the change in VAR when here's a thought experiment, when the ith portfolio, this is confusedly worded. We're just going to remove the ith position and compare the VAR with that position and without that position. And then the VAR without the position might be more or less. The difference is the incremental VAR. Marginal VAR is another way of looking at that. And that is just a small perturbation in the size of the position. So, for example, the weight of that position gets a little bit added to it. In that sense, it's for the portfolio value, it's the partial derivative with respect to that weight. And that's additive. I think that's relatively easy to see. If you remember a minute ago, since the value of the portfolio is just the sum product of the weights and the positions. So if you write all the marginal VARs, let's say in a report, then you can easily see that the A marginal VAR and the B marginal VAR of a two-position portfolio, AB, will sum to the AB marginal VAR. And just to note that these incremental and marginal VARs can be negative or positive. They don't have to be positive in the sense of loss. It's possible that if you have short positions and some other complicating things, and because of anti-correlations and diversifications, that removing an asset may make the portfolio riskier, or it may make it less risky. Anyway, in the textbooks, we decided to extend these concepts to PFE, so we can then talk about the incremental PFE and the marginal PFE. And I would just say, from my perspective, if you aren't doing this already, the desk should use this. Essentially, you could use this in a more effective way, for example, to see what the initial margin is really paying for. It may really be that there's a single position or a small number of positions, let's say in a large 100-asset portfolio, that really are the ones that are demanding the highest initial margin. One could then go to the counterparty and say, if you think the initial margin, if you're complaining it's too high, why don't you, remove this asset from your portfolio, and the rest of it, we can transact on. All right, so as I said, I promised you Monte Carlo, but first I want to talk a little bit more about wrong way risk. There's some interesting modeling involved. So first of all, let me give a formal definition of wrong way risk, and this is right from Basel. There's a difference between specific and general that are similar to the capital asset pricing model definitions of, general risk and specific risk. That general has to do with kind of exogenous effects like the market, and specific is firm specific. So to take specific first, that's like selling the puts on your own stock. It is the, the probability of default positive correlated with the exposure, right? On the other hand, general wrong way risk, and I will give some examples of these, is when the PD is correlated with a market risk factor like interest rates. So here's a specific example of wrong way risk. Remember, bilateral transactions are the ones that the bank is, let's say, most concerned about when doing PFE, that a counterparty may miss a payment. So here's just a simple total return swap. It's referenced to a bond, and Alpha Incorporated is the counterparty, and Alpha Incorporated is paying based on LIBOR plus 5%. I guess the slide is a little old, so let's say SOFR, 30-day SOFR plus 5%, 90-day SOFR plus 5%. So clearly, then if interest rates go up, then the credit position will start deteriorating, and now Alpha is important. That's a problem. All right. So you could say it's based on interest rates. I guess this is maybe a confusing example, but really what's happening is the credit quality of Alpha is deteriorating, and that's the problem because it's based on a floating rate debt. Hull and White put out one of the models of specific wrong way risk, and in this case, we're asked to think about credit default swaps, where you have these reduced form models where there's a hazard rate, and from that you can infer the probability of default. But the hazard rates are the stochastic variables. Essentially, it's a stopping time type of thing that something is expected to default at some point in the future, some unknown point. Let's suppose that the exposure is given by capital V, and then the hazard rate can be related to capital V exponentially. So you can have exponential growth in exposure, or you could have exponential decrease in exposure, e to the x versus e to the minus x, say. That's controlled by the sign of this parameter B, and then A is essentially just so you can do the calibration and match, let's say, CDS spreads or some other measure of the counterparty risk in the market. In the general risk example, I guess what I would say is, something like the currency rate is completely out of control, out of the hands of the company. Its credit rating, that's maybe a little bit more on the specific side. So here's an international transaction between a U.S. bank and a Peruvian counterparty where soles need to be delivered, that being the Peruvian currency. So if there's a depreciation in the sol, then all of a sudden the counterparty has to spend more Peruvian sols because it needs to deliver US dollars. So that's not a risk in the correct direction. General wrong way risk is a bit harder to model. For one thing, any number of factors could be the issue. In the specific case, we really do focus on the counterparty itself. Glasserman and Yang, 2015, used a simulation analysis, as will be described in general in a little bit. They begin with the fact that, as stated before, when wrong way risk is not taken into account, and specifically general WWR here, that we're underestimating the PFE or the CVA, whatever quantity it is that you wish to estimate. I'm sorry, that's meant to be the actual PFE here. However, one can still get an upper bound on how wrong you might be. What's the worst case scenario? What is the biggest problem, the biggest underestimate? Okay, so what they do is they take, just as in the Hull White model, they're looking at the interaction of the market and the macro factors to the position. So for example, an option position might be parameterized by its implied vol. And as we said before, the counterparty is expected to default at a time t. So from the charts on the left, let me explain this. This is for various flavors of the model that's controlled with a penalty parameter on the horizontal axis. And this is telling you in percentage terms how bad for various values of volatility you might be off in your underestimate. And, it says 400%. That means you might be underestimating your exposure to the counterparty by a factor of 4 to 8. And that's the same thing true. The larger the hazard rate, this underestimate is going to be an increasing function of the hazard rate. All right, so that's essentially the whole wrong way risk discussion. Now let's go to a kind of deep dive into Monte Carlo methods. And some of this is presenting some new ideas that I developed for what I call two-dimensional convergence analysis. So, okay, so basically, we have a finite number of sample paths n, but they could be very large, and we can sample the counterparty portfolio for possible losses or gains. To go back to the front desk, we could use Monte Carlo, for example, to do Asian options, because that is path dependent. And then the price would be the sample mean over those paths. This is a nice problem, a Monte Carlo mean estimation, because by the central limit theorem, we essentially know that sampling from any distribution, if we take enough simulations, will be asymptotically normal. And so therefore, there will be convergence in the mean. It's just a question of how many trials. And the functional form is 1 over the square root of n. In other words, the variance in the central limit theorem goes like 1 over n. So in counterparty credit risk, there's some key differences. One of them is that now we need to estimate a tail quantity, a 99th percentile, for example, not a mean. And the way that things converge in the tail, if you just think about it, is distribution dependence, right? Just like I believe earlier we spoke about integrating the tail of a distribution for expected shortfall. So that's going to be different for every empirical distribution. The central limit theorem, after all, is for the center of the distribution. That's why it's called the central limit theorem. There's no guarantee that the tail will converge and look like a normal tail. So that's one issue. Another one is we don't know what the right answer is here. Again, if we're on the desk and doing Monte Carlo pricing for an Asian, we can take a limiting case and use it to price a European option, and then we can use Black-Scholes. So then we could say, how close can we get with 1,000 simulations, with 10,000 and so on, to a European option price? We don't even know that in general, that increasing the number n will actually decrease this variance. It may not be monotonic in n in general for a general portfolio. We can hope for that, so then we could do like powers of 10 in the number. But even in that case, where do we stop if we don't know what the answer is? Okay, so that's a question that we don't really know how to answer. Here's an approach which can get some insight on it, and we'll give a possible solution to the problem. So let's really think inside the box about what random variables are. So we're sampling from sequences of random variables. Ultimately, these are sampling from a uniform distribution in general. And that algorithm has a seed to start, so that there are different sequences of random variables you don't have to use the same one all the time, and you can reproduce the same result if you go back to that seed in the future. Well, that's a problem because that introduces seed variance. I mean, do this thought experiment. You go to the regulator 1 week and you calculate PFE this way with seed equals 0, and then you do it with seed equals 7 next week. Well, you're not going to get the same result, right? There's going to be what I define as seed variance. In other words, one really would like to so you go into this and you think it's an ordinary problem, monovariate problem, univariate, excuse me, but it really is a bivariate problem. There are two distributions. There's the inherent distribution of the losses, and then there's the distribution of the seeds. So, here's a section that I wrote in the textbook summarizing that. The same seed, same portfolio, you get the same PFE. But what's the right seed? Is it seed equals 0? Is it seed equals 7? The answer is they're all the right seed, but you need to think about them as successive experiments, like in a physics lab. Like, here we go. I'll talk about that in a moment, but let's just review what if the seed doesn't matter, then basically what we expect the behavior like this, that let's go back to that European option case. We know the answer, so we can do the Monte Carlo for a certain number of realizations. That's what's on the horizontal axis. And we can calculate the error relative to the closed form Black-Scholes value, right? And we expect that will go down. This is going down like 1 over squared of n, where n is the value. But again, we don't know what the value is for PFE. And using a different seed, let's say S prime instead of S, will make this look different. Okay, so I want to motivate then what I call two-dimensional convergence. I'm a former physicist, and we teach students to take multiple trials and average them in the lab, right? Freshman physics, for instance, high school physics. So a classic experiment is to measure the period of a pendulum of known length, and from that to infer the gravitational constant, 9.8 meters per second squared or whatever. The 2D convergence for PFE is analogous. We need to take multiple seeds, just like we need to do multiple measurements to get the familiar square root of L over G relation. And that's convergence. And then we can use that convergence to figure out how close we are to the right result. So this is just what I mean by 2D convergence. If you look at the first column, this would be what one would do traditionally. One would stick to one seed and just increase the number of realizations. What I'm saying is, if here the n is along the rows, let's introduce the columns as well. And so these 3 represent n seeds. That's a ... In practice, something like 10 seeds was something that I used to do these experiments. You could use 20, 30. Essentially, you're trying to get to the point where the seeds are sampled with the central limit theorem. And so therefore, the mean and the standard deviation have a small amount of standard error. So then you can take row averages. That's an average, for example, over the seeds at 10 realizations and the standard deviation of those seeds. Okay, so what do you do with that? Well, now we can talk about risk appetite. We can talk about the risk tolerances of the bank, because usually these are stated either in absolute terms, like, 100,000 is a de minimis loss. We want to make sure that we lose no more than a certain quantity, something like this. So to do that absolute risk, we then would look at the two-dimensional chart that I showed a minute ago and find the point where, we've gotten down so that the means then are, getting close to an error of about 100,000. We could also talk about it in terms of relative risk, and that could be, like a percentage, and that traditionally is done using the dimensionless standard deviation over the mean. Usually you take the absolute value because while SDEV is always positive, it's the square root of a sum of squares. The absolute value of the mean is necessary because sometimes it could be negative. And you really want to compare these things in magnitude, not in distance from the origin, not in, you know, the numerical sense of less than or more, and including the signs. So that's basically the 2D treatment. I see we're running up to about the quarter of the hour. I think I can wrap this up in the next 5 minutes and then leave a little time for questions. So let's just talk a little bit about how you generate these random variables. This is a script n here because I'm going to still use the ordinary n to mean the sample size, the number of realizations. So a standard normal distribution of mean 0 and variance 1 is what we source from. And we expect that there's some sort of monotonic convergence. This is essentially 1 over n to the x, right? And, you know, and then x being greater than 0. So, you know, an example would be to generate normal random variables. And the way we do that is by using the normal cumulative density function, CDF, capital Phi, sampling on a uniform distribution. So, for example, you can do that yourself with some simple Excel commands. Those are called pseudo-random numbers. That is the uniform ones that are in the Excel algorithm. And if you do that, then you'll get exactly 1/2 by the central limit theorem. Now, supposing we could deal with something called quasi-random numbers, in which case x is greater than 0.5. Maybe we could even get the convergence to go like 1 over n instead of 1 over square root of n. Then that would be a faster convergence. That's desirable. That's why a number of sequences have been dreamt up. Some, I think, are even patented. And for these large calculations, large n calculations like PFE, we use them. So Sobel sequences are the most common. I mentioned Halton here as well. In some experiments that numerics did for a low number of dimensions, let's say a low number of assets in the portfolio, in this case, you may be able to achieve an x of 1. That is a 1 over n convergence. More practically speaking, it's probably not too distant from 1/2, but it is greater than 1/2. Okay, I wanted to touch very briefly on then the Basel understanding of PFE, because the PFE does have to be reported, but it's done by a formula with not much explanation. It's basically these two, that a PFE is dependent on the position value and a collateral haircut. So they're thinking about this essentially very much in terms of the collateral, so that this is kind of a generic PFE. Like I would not use this PFE on the desk to do initial margin. But, you know, I'll just say that a number of different asset classes are included in this. That, again, it's a kind of a lookup table for each of these different kind of positions that are exposed to counterparty credit risk that can go into this formula, and you just sum over each of those asset classes. I've given the references. This is, you know, it's a lot more like bookkeeping. Good. So that concludes the talk. I just have 2 slides to step through. One of them is the link for this talk. If you're watching this on YouTube or some other source, then you can see the YouTube link here, and this is the Zoom meeting here. And the last slide is simply my contact information, email, WhatsApp, or go onto LinkedIn and do a connection request. All right, so I'm going to then, if I can, as a boomer, I can do this. Stop the share. Right. It's Greg. Okay. I see, Greg, you're on the call. There may be other people on the YouTube, which I can try to crank up and see if there's chats on there. How you doing, Greg? Long time no talk. Yeah.
Well, it's been too long, and thank you for what you've done. It's excellent.
Sure.
Weigh in for me. Could you go back to the first slide integral, please?
Yeah, sure. Reshare. Um,
I logged in just as you had that flashed up.
yeah, I'm going to put these slides online as I usually do, so
Thank you.
don't feel like you have to
I
rush
couldn't
them.
couldn't copy it.
Yeah, I think it's pretty standard. I think I cut and pasted it from Wikipedia. This is the one. I can enlarge it.
Yeah, can you talk me through, if the integral is the sum of the, the marginal slices,
Right.
how would that apply here, please?
Yeah, so the idea is that this is essentially even for a single asset, you can do this. You have, let's say, some information about three quantities: the loss given default, the exposure at default, and the probability of default. Let's say that you know
Mhm,
all of those things as a function of time. Um, then the first thing you do is you multiply these two out, loss given default times the exposure. Then you take that expectation in the integral at a particular t,
mhm.
and it's the expectation with the Q, or the risk neutral measure, because this is CVA. This is essentially an added fee to the derivative price. And then that integral is going to be over the evolution of that probability of default over time.
So how could I understand the Q measure, the risk neutral measure?
Oh, okay. So that's basically the that's developed often in these courses when we just have a simple one asset portfolio, and that it can only go up or down, right?
Hmm.
And so depending on the volatility, so you might think that there's a 50% chance of going up or down, but it depends. And these things are done in the risk neutral world,
Mhm.
in the sense that, so it sort of depends on what the distribution of what you're looking is. A given stock may have a higher probability of going up than going down.
Mhm.
Um, when you calculate a simple call option on a stock, then the probabilities that you're calculating are the risk neutral probabilities.
Yes.
If I tell you that delta is 10%, that means that in the risk neutral world, there's a 10% probability that the call will expire in the money and you'll make a profit. But that's in the risk neutral world, right? That's what you have to. So traders will say, well, there's a 10% probability. Well, we don't live in the risk neutral world. So I can use it to price, but if I really want to know what the probability is, then I have to do something more like the historical one.
Okay.
And in general, we just go back and forth with that. My point was just that the front office does pricing, so they're always in the risk neutral measure. In the middle office, we're always in the historical measure, because, like an insurer, we're looking at the past performance.
Mhm.
Um,
So that puts that tree up and down step together with historical percentage changes.
no, you don't use them there. For pricing, it's a beautiful result of Black-Scholes that there
Yeah.
is no, the mean, the mu, right? The stock return has nothing to do with an option price. It's only the risk neutral rate.
Okay.
Um, but if we do VAR, then we're definitely using history. And so when we look at the losses over the last year, let's say the last 250 days,
Mhm.
those are realized losses. So those are building in even if it's implicit, those are the historical probabilities, the actual ones.
Historical probabilities, and that's got if there's a trend term, it's in the historical.
That's right. And so, it's a little bit disingenuous, because if you do delta, let's say delta hedging on the desk, you're doing that with risk neutral probabilities. But
Okay.
if you want to actually talk to management or Basel and figure out the capital to cover them, you're doing them historical probabilities. So there's an inconsistency.
That's the main lesson out of this
Right.
time for out of this session for me. That's the main lesson. Thank you.
Yeah. And that was something, yeah, I worked at Jefferies for over a year, and we went back and forth on that. I'm actually, I'm looking around. One of the jobs I'm looking at is an effort to attempt to unify the first and second line defense ways of thinking about risk. Because, if we start to look at a volatility surface, for instance, the risk that you calculate on the desk is going to be different what it is, let's say for an option that for a point on the volatility surface that's way out of the money. That could be very different between the first line of defense and second line, and that's a problem.
Perfect. So, I'll look at these slides online. If
Sure.
I have like an application question, I'll email you.
Yeah, let me know. On the last slide I put up, so this is one of the slides, so you can use my pro email. You probably have my Gmail, so you can use that as well. I just use this because
Okay.
sometimes when people are behind a firewall at a
Okay.
bank or FHLB or whatever, yeah.
Okay. And then, are you in the New York area now?
Yeah. So I bought a place in Brooklyn, renovated it. It took forever. We still have some stuff done. But yeah, I'm in Flatbush, I'm on the Q train and I
The
can come
queue
and
is
see
good.
you
Okay,
anytime.
the queue. I'm on the queue.
Good.
So,
Yeah, happy to catch up. Yeah,
yeah, I'm like fully booked until Wednesday,
right.
I think. So,
Yeah, we can go
I've
I
got
mean,
I've got a dentist appointment on Thursday. Is there any chance of meeting up like Thursday afternoon? I can come out to Brooklyn if you want. I can get on the queue or wherever
could
you
be.
are.
Yeah, I'm in a model risk, this model MRMIA, Model Risk Management International Association is having a 1 day, it's online, but I want to stay in that. I don't know, on my
Okay, that's
calendar.
on Thursday. Well, it could be Friday or any other day. I just, it's been so long since I've seen you, and
Yeah,
just like
sure. Yeah, definitely good to
free
talk.
association ideas I'd like to exchange with you, really.
Right. And I'm in the market. I basically took off the last year the book was like an infant, it had to
Hmm.
be born, it had to be whatever. And now the book is ready to go to preschool and
Hmm.
I'm, looking to
The
get back.
book, okay, the book. All right. So, um,
But yeah,
I have one idea for you. I'm going to send you
okay.
offline here. I have one idea for you.
Yeah, I'll reach out to you and yeah, I have actually a job interview but it's first thing with London on Friday morning, but yeah, I could do lunch or I could do sometime in the afternoon on Friday.
Friday would be cool.
Yeah,
Yeah. Okay. Well, I'm smiling because you're a special person
thanks.
in the market and to me. And thanks for being so generous with this. This is
Sure.
unavailable anywhere else to my knowledge, what you've just uh, synthesized.
Yeah, happy to talk more, and I can even page through some parts of the book, although it's a messy word manuscript with a lot of markup. But it's like, we're going on, it's over 300 pages now with, a lot of different, we're trying to be the first real textbook on model risk. So, yeah.
Oh, okay. Have you ever seen the what I'll call, they're not new anymore. They came out during the pandemic, maybe 2021. The GARP FRM textbook series, which is like now 12 module books, 12 books.
Yeah, I'll definitely take a look.
I mean, they're expensive. I bought them because I
Right.
worked through it during the pandemic. I got, oh, I think are the newest ones. Um, I'll talk to you more about that because that's one of my
Sure.
references. That's one of my references, and there's often questions come up there that
Yeah,
I
that's
could
fine.
I could
That's right.
I could you know throw over the head over the wall with one of those questions and see what you
No, that's fine. I like
think.
that. I like trying to explain complicated things. I usually explain
Simply.
model risk management is, owning a rental car business of, that the models are like from the simplest to the most complex, from, like a Cooper or maybe even electric bike to, a Tesla. And the different models, that different investors or counterparties would want, you have to make sure they're all maintained. So someone steps in and says, I want to rent this $100,000 Tesla. It has to be maintained just like the Cooper and the electric bike. So that's the role, I think, of a model risk management. Yeah.
You're you're a special person, and I want to keep in touch with you. Thank you.
Thanks. Yeah, let me go offline. I got a 9 o'clock that I got to
Yeah,
jump to.
go. Thank you very much again.
Yeah. If I can find your email, I'll try to send you the latest draft table of contents. That'll give you a little more perspective of the book.
Very good. Very good. Good luck on Friday.
Thank you. Thanks a lot. Talk to you soon.